Financial markets don't move in a linear straight line, and 2025 was a reminder of that for all of us. The year was eventful, a lot of global events happened, and there were a lot of uncertainties as a result of that. As we finished the first month of 2026, also, the global uncertainties continue to evolve. Before I go into what could be possibly the strategy for 2026, let me give you a recap of what happened in 2025 and what we did at various points. As you might recall, the Indian equity markets had peaked out in September 2024, and markets touched the all time highs, and then we saw some correction post that. The first phase of correction was in October 24, leading up to some consolidation in the beginning part of 2025. The budget of 25 was not extremely pro risk kind of a budget, which means investors did not see much to go back to the equity markets. The global macro factors were uncertain. Indian macro were also slowing down on some of the aspects in 2023 and 24. As a result, in the first quarter of 2025, it was quite obvious that 25 was not going to be the year, at least in the first few months, where risk on trades will happen. So we had to recalibrate the asset allocation strategy. Now, one thing that was moving very, very strongly was the commodities part. Gold had already started its rally in 2023 as a part of the de-dollarization trades which was going on globally. Again, if you go back in 2022, we had the Russia Ukraine war that started. And towards the end of 2022 is when US imposed sanctions on Russia in such a way that it also froze its US Treasury assets. That kind of sent a shockwave across the globe where a lot of global central banks started questioning their strategy of holding a lot of US Treasury. Because if US were to freeze their assets also for whatever reason, it results into a liquidity issue for central banks. So that was the trigger for global central banks to start looking beyond US Treasury to park their reserve money. And the most obvious choice was gold. So the gold price started rallying. In the beginning of 2025, based on technical charts, we believed that silver actually had a stronger run than gold. This was based on the price ratios, this was based on the technical charts, and somewhere in February, March 2025, we added silver to a lot of client portfolios based on the risk profile, based on the asset allocation that we required. And that turned out to be a good strategy for 25, where equities were giving single digit returns. The silver outperformance actually offset that. 2025 was also a year where we saw US dollar appreciating significantly against the rupee. When that happens, what you have to understand is global investors who invest into India, we call them foreign portfolio investors, they tend to lose their dollar yield on the Indian equities. So they're investing dollars, converting into rupees. So when rupee depreciates, their net returns in dollar falls. And again, India is not the only country in the world that they can invest into. So they essentially led to a situation, they essentially created a strategy where they started to sell off from the Indian equity markets and redeployed in global equity. US equities was continuously doing well on the back of the AI boom. The top 7 to 10 companies in US, the tech giants, were spending so much in the AI infrastructure that a lot of money went to the US markets. And of course, if you look at the charts also, they have done well in 2025. Now, what it meant for Indian equities was a massive sell-off from foreign investors. 2025 witnessed the heaviest selling by foreign investors in the last almost 25 years. Now, just based on that, if this was a decade back, markets would have crashed much more. What supported the Indian equity market was the resilience of domestic investors, the retail investors investing into the IPOs, the retail investors investing through mutual funds, insurance companies, NPS, pension funds. All this buying of Indian equity in 25 supported the markets. The SIP book continued to remain strong. We did not see any major dip at any point in time, which is a very matured sign about Indian investors that they behaved in 2025. Now, As we step into 2026, a lot of uncertainties have continued. Somewhere in the middle of 2025, there were early indications that markets are finding its mojo back. I had mentioned in some of my monthly commentaries that probably post Diwali in the last quarter of 2025, markets will reclaim the all time highs. And it did happen. We did see all time highs in the end of 2025. And my view going into December 25 was markets will be able to find its momentum back in the first quarter of 2026 also. Why did I say that? A lot of factors again. The rupee had depreciated to a very, very low level, which means we had crossed 91 also. That's a level where typically from a risk reward point of view, if you're a global investor, you would want to probably relook at investing back in India to some extent. Second, the Indian macro consumption story was coming back. So after a slowdown, it had started to recover. Corporate earnings after a slowdown has started to recover. So there were a lot of indications that the markets could recover. However, the biggest jolt came in 2026 in the form of Trump's action. So what US did with Venezuela and what they tried to do with Greenland escalated geopolitical tensions, escalated the issues between US and European Union. China, on the other hand, has been doing certain things for its own interest, which is disrupting some of the demand supply aspects in many of the commodities market. So Jan has been an extremely surprising year for the markets. I don't think the markets expected that January would be this. We do expect some kind of slowdown in Jan, but it was a negative month overall. Now, obviously, the budget announcements will come up. So as I record this video, the budget is not yet come out. Tough task for the Indian policymakers because they have to balance two things. One is sentiment. You don't want a situation where the foreign sell-off from India continues to happen. And the second is they obviously want to continue supporting the Indian macro. So how do they do it is something which we have to see from the budget announcements. I hope there'll be something strong around it. Now, 2026, I think the focus will continue to remain on asset allocation for us. We don't want to put all the money into one bucket only like equity. While equity still would be a double digit performing asset class over a period of time, it may not be necessarily going up in the next few months with so much of uncertainties prevailing in the market. The gold and silver rally has reached unsustainable levels. We saw significant correction in that rally last week, where in a day it gave away the entire returns that was generated over the last 2 or 3 weeks. Now, please understand commodities don't really have a fair value. It doesn't have an intrinsic value because it doesn't give cash flow. So it's all driven by demand supply. And China is creating a lot of demand for a lot of commodities, including precious metals as well as base metals or hard metals, as a result of which you're seeing prices going up all across the board on the commodities front. One of the things which is easy to do is get into a FOMO mode, a fear of missing out, and go into the commodities bandwagon. But please remember, it will be an extremely volatile phase for commodities. Double digit daily swings would become more normal, especially in a product like silver. Again, a point to remember is commodities can be produced or supplied in most cases. One can argue that gold supply is probably finite, but that is not the case with silver or copper or uranium or some of the other products which are also going up. So we have to be very, very cautious about when the supply may come up. We have also seen China, after accumulating a lot of commodity, after increasing the prices in the global market, dumping it back. We have seen that with other commodities in the past, like soya bean, for example. So we have to be very careful. It has to be an asset allocation play that we will do in the commodity space rather than a trading call or a momentum call in that sense. The core of the portfolio will remain equity, and within that, the core will always remain mutual funds because they are more diversified and less risk taking. Equity stocks will remain volatile. I think that is the nature of the stocks anyway. So there will be a lot of volatility that you will see. January 26 has also shown us that markets have started re-rating the sectors that they are going to back. So they've heavily sold off some of the segments which was seeing interest earlier. For example, some of the pharma sectors, which is into API formulations, some of the segments into electronic manufacturing space, for example, all that has started seeing some re-rating. And the market is now looking at segments which will benefit from the Indian consumption story. So government has to ensure that in some ways or the other, job market continues to do well and the consumption is supported. If that happens, automatically a lot of sectors and stocks will be able to benefit from that. And India as a country will be able to continue to grow at the same rate without depending on global markets. Of course, as you're aware, the US India trade pact has not been signed yet, so the tariffs are still high. India is trying, obviously, to offset it through various other mechanisms. So, the trade deal with EU, the European Union, is something that India has attempted. While it is a good thing to do, the net impact of the EU trade deal is not going to be very high for the Indian macro. It will offset some of the benefits that we will get from exports with some of the benefits we will lose on the imports, because please understand it's a trade deal where you have to create win-win for both. So a lot of domestic segments will also get affected because import duties have been reduced for a lot of these European products, for example, chocolates, let's say, or wine, for example. So it will be a net neutral impact, is what I think. I don't think that is going to create a major macro impetus. What we have to keep watching is corporate earnings. Quarter on quarter, how are the corporate earnings doing? We have to keep watching on the domestic consumption trends. We have to keep watching the domestic investor flow. So the SIP books become important. One of the data points that is critical to remember is anybody who has started the mutual fund SIP investment journey in equity from 2023 calendar year is now currently sitting at single digit rate of CAGR. Now, the last thing which Indian markets want is the investors losing patience and starting to discontinue their SIPs and start believing that, oh no, there is no real returns going to come. So if they are resilient, if they believe that over the next 3 to 5 years we could still see double digit returns, that would obviously mean that the domestic support for markets will continue. So broadly, the theme for the rest of 2026 from a portfolio building perspective is simple: asset allocation. The biggest part of long-term wealth creation is always asset allocation. So equity, commodities, US tech exposure when we get an opportunity if there is a correction in the US market, exposure to real estate through REITs and InvITs. Again, when the opportunity comes, when those prices cool off, these are tactical allocations that we would continue to do in investor portfolios. And the net result is to attempt keeping the portfolio returns at a level where it has to support your net worth growth. Now, please understand at a component level, at a micro level, things will be volatile. A particular stock in the portfolio may be down by 25%, but please remember that is always going to be the case. You cannot have a portfolio where every single instrument is going up in a linear, constant way. Some will do well, some will do badly, and that is why asset allocation is very important. We will at no point have a scenario where just because silver is giving good returns, we invest 50% of the portfolio in silver. That is not gonna do well in medium to long term. So please remember, keep the focus on the portfolio returns, keep the focus on what's the overall rate at which the investment portfolio is growing rather than individual components. While it is a dream case where every single component and asset class does well, it's not very logical to think like that because some of the asset classes have negative correlations also. So the theme is very simple: keep the focus on what exposure is being taken in what asset class, what is the potential growth rate of this asset class over the next 8 to 10 years, and that will always go back to fundamentals. You can have momentum and sentiment affecting prices for a quarter or a year or even 2 years, but if you zoom out and see it over a period of 8 to 10 years, fundamentals do matter. So we will continue to look at quality schemes, stocks, businesses that can support the equity side while focusing on some asset allocation calls on real estate, commodities, fixed income, etc. So that's where we are. And as always, you will get updates from us. If you have any questions, please feel free to reach out to us. Thank you. Have a great year ahead.